Dobar dan. That means good day. TalkCast PDX. Find us on the web at talkcastpdx.com. It's Tuesday, August 3rd. Name of the show is The Bogdanich Perspective. You can look on that on YouTube, Spotify, blah, blah, blah. And welcome. I'm Paul Bogdanich, your host, by the way. Name of this today's show, I'm going to call it Dearest Marie. And that's not going to become clear why until the end of the show. But that's what we're going to call it, Dearest Marie. A lot of good races at the Olympics. I'm not going to dwell on it, but last night they ran the men's 400-meter hurdles. If you haven't seen it, do. The athletes are great. The rest of it is regrettable. No crowd, no crowd noise. Usually when you have a running race, the crowd gets all whipped up and, they cheer for the athletes. And then when the guy calls set, the crowd goes absolutely silent. And then, when the starting gun goes off, then the crowd roars for however long the race is. And that's just totally missing from this Olympics. It's very sterile. So in that regards, it's awful, but the athletes are great. I follow hurricanes and earthquakes, principally because I like the statistical modeling they use. In particular, our guys at the Hurricane Center, best in the world. Fluid dynamics, and the earthquake guys have a particular problem with long-range probabilities, which applies to the stock market, infrequent, probabilities. And so I follow them, and I'm signed up with the USGS on this website, and every time there's a greater than 5-point earthquake, I get an email. So I watch these things all the time whenever there's a good one. And last week on Thursday of last week, July 29th, we had a great earthquake in Alaska, technically, 140 miles southeast of Kodiak Island, which is out in the ocean, right under the fault. But it was an 8.2. Anything greater than an 8 is what's referred to as a great earthquake. We've had 36 great earthquakes since the widespread use of the seismograph back in 1900. So about one every 3.5 years. So I figured I'd mention it. It's an interesting quake as far as earthquakes go. One, because it's large. Earthquakes, the way they measure them, the Richter scale and all the modern scales, they're complicated, but it suffices to say that generally speaking, they're all logarithmic. So if you have a magnitude 6 quake, that's 10 times more powerful than a magnitude 5. And if you have a 7, that's 10 times more powerful than the magnitude 6 and 100 times more powerful than the magnitude 5. So when you get up in the high numbers, above 7, these things are very powerful. And we had an 8.2, 140 miles southwest, of Kodiak, Alaska, last week. And what's interesting is, like I say, I get these email alerts. And last year, what was it? It was in July of last year. The region became seismically active. They had a 7.8 in July of last year, and it rung it like a bell. Yeah, there was a big earthquake, 7.8, and they had literally hundreds of aftershocks lasting months. And then in October of last year, they had a 7.6 right in the same spot. And that did the same thing, lit it up like a Christmas tree, tons of aftershocks. And then this last Thursday, we had the 8.2. So what that means is that those shocks last year in July and August of 2020 were what are referred to as foreshocks. They're not the main shock. As far as we know, this one last Thursday was the main shock, but we're not absolutely sure of that either. The faults up in Alaska throw off 9s. What was called the Good Friday earthquake was up in Prince William Sound, Alaska in 1964, 9.2, which is the second largest earthquake ever recorded. And speaking of foreshocks and the largest earthquake ever recorded, May 21st, 1960, 6:02 in the morning, down in Chile, an 8.1 hit the coastal region, what would be the west coast of Chile. Tremendous damage, loss of life, but it was an 8.1, 6:02 in the morning on Saturday, April 21st. April 22nd, Sunday, the day after, 10:30 in the morning, they had a 7.1, which is much, 10 times less than the quake the day before, but still very powerful. Later on Sunday, the day after the main quake, at 6:56 in the evening, they had a 7.8, which is almost as powerful as the 8.1 that started the event on the Saturday. And then at 7:11 in the evening on Sunday, April 22nd, 1960, a 9.5. And that's like 15 times more powerful than the 8.1 the 2 days before. Largest earthquake ever recorded. And that was in 1960. Prince William Sound earthquake above 9 happened in 64, so only 4 years later. And then the next earthquake above 9 was the Christmas earthquake that destroyed Aceh, Indonesia in December 26, 2004. Don't quote me on that. Might have been 2005. And then there's two others. The one that destroyed Fukushima was the most recent, on whatever that was, March 11th, 2011. I can't remember what the other one was. But anyway, great earthquake in Alaska last Thursday. Thought I'd mention it. We got more than 3 years till the next one, or maybe not. It's hard to say. If that little 8 that we had last Thursday was a foreshock, we'll see the other one within 2-3 years. On to the markets. I've been reading the press more carefully than I used to come up with content for this show, quite frankly. The thing that strikes me the most is, depending on what news source, if you confine yourself to a single news source, your view of the world is going to be entirely different than somebody else who confines themselves to a different single news source. All of them stay within a relatively narrow narrative band. Picked an example. Last week, I don't know what you read, but, whatever your headlines were. But last week on Thursday, again, same day as the great earthquake in Alaska, we issued the GDP report, for the United States. GDP stands for Gross Domestic Product. It's the largest, most comprehensive report on the condition of the economy. What's the gross domestic product? And the GDP report that was released last Thursday, July 29th, was for the quarter, the 3 months ended June 30th, 2021. And this is from the Wall Street Journal, mind you. Okay, so the Wall Street Journal is arguably the premier financial press in the United States. Okay. And front page above the fold, the headline was, U.S. economy grew beyond its 2019 level. If you were unaware that was based on the GDP report, there was nothing in the headline that told you that the GDP report was released. The first paragraph in said article, this is a quote, the U.S. economy grew rapidly in the second quarter and exceeded its pre-pandemic size, but the outlook has suddenly turned cloudier due to the fast-spreading Delta coronavirus variant, unquote. The article was 21 paragraphs long. 12 paragraphs talked directly and extensively about the Delta variant and its effect on things. They did mention that GDP, the first estimate for the second quarter, grew by 6.5%. They characterized that as grew rapidly, 6.5%. They did not mention that economists' consensus expectations for the same print were in between 7.5 and 8.6%. So that by expectations, it was a big disappointment. They did mention that the economy, based on the second quarter GDP report plus the first quarter GDP report, which, by the way, on this, the first quarter GDP report for the quarter ended March 31st also printed at 6.5, but on this GDP release, they revised that down to 6.3. They never mentioned that in the article. But based on those two prints, they did mention that the expected size of GDP in the United States in 2021 is going to be $22.7 trillion. And they characterized that as exceeded pre-pandemic level, which is true. 2019 was $22.5 trillion. So it did, if we hit projections for the third and fourth quarter, technically exceed that. Other little tidbits. A GDP report is not too much text, tons of tables. They don't opine on why or how. They just state the numbers, and they're very thorough. It's a very good report, rather dense, rather long. I read it. Other little tidbits that were left out of the article in the Premier Financial, and repeated nowhere else, mind you. But look, current dollar personal income, in other words, what the average person has to spend, decreased 22%, or $1.32 trillion over the 3 months ended June 30th, 2021. Okay. Principally because of the elimination of certain government benefits, from the COVID and other things. But 22% drop in disposable income at the bottom levels of society, $1.32 trillion. Okay, private inventories, which is stocks on grocery shelves and so on, down $72 billion, which is on top of a $164.6 billion decrease that happened in Q1, which is on top of a $124.3 billion increase that happened over 2020. You add those three numbers together, you come up with over $360 billion worth of inventory that's not on store shelves. And you see this when you go into a supermarket or a Rite Aid or a Walgreens or wherever you go, except the liquor store. They're still full. And I appreciate that. It's not a supply shortage. What it is these corporations they're not carrying the same inventory levels as they used to, maybe partly because they're unsure of their ability to sell it, based on how crazy their particular governor is, something like that. As I said, they mentioned that the annual GDP rate, also not in the report or any of the press, but they mentioned that the rate for 2021 is expected to be $22.7 trillion, right? We know from, I looked it up, but the national debt as of the same day was roughly $28.5 trillion. Tell you how we know that in a minute. But it was $28.5 billion. And so if you take that $28.5 billion and you divide that by 22.7, which is the GDP, the expected GDP for the year, you come up with a debt to GDP ratio of 126%. For any mature corporation that doesn't have the ability to double or triple or quadruple or quintuple its revenues. That's how come Netflix stocks trade so high, for example. They expect that they will double their revenue in 3 years, right? There is no way that a mature nation like the United States can double its revenue in 3 years. You could, but you would have to impose a wealth tax and an entirely different government, not with the same government. But if you have a mature system like that, you can't repay anything over 100%. We're at 126. Had an article submitted to me last week. It requested that I translate it or expound on it. And it appeared Saturday, July 24th in the Wall Street Journal, and it appeared on page B3. The headline on said article was, Yellen urges Congress to act on the debt limit. The current ceiling on the debt limit expired on July 30th, I believe, or 31st. The debt limit was $28.5 trillion, as I already mentioned. And it's a letter in 1917, which was in the middle of the First World War. The American government, under then President Woodrow Wilson, I believe, was using the Treasury Department of the United States to borrow money and produce arms and send them to the Allied side under, I believe they called it the Lend-Lease program, but I might be confusing that with the Second World War. I can't remember which was which, but they were borrowing money. Congress didn't like that because it was being done without congressional authorization. So in 1917, Congress passed a law that the Treasury Department, which is an executive department under the president, was not allowed to borrow more than was authorized by the Congress of the United States. And they created what was referred to as the debt limit. In those days, the debt limit was paltry by modern numbers, a couple of $100 million. In the 100 years, roughly, since 1917, they've raised it 100 different times. And this article from Janet Yellen, remember the article that I'm supposed to be translating here, Yellen urges Congress to act on debt limit. She sent them a formal letter saying that the United States government is not going to be able to pay its regular bills past August 1st, which was 2 days ago, because they're going to run into the debt limit. And they have to go to what's called emergency procedures, which they did. There's an article about that in today's paper. And they'll be able to pay Social Security and all the rest of these things through roughly, call it October 7th. And the fiscal year ends September 30th. So the Congress before September 30th is going to have to raise the debt limit. They do it every time. It becomes a political football. But this article was occasioned by her sending a formal letter saying we're up against it. We've hit the $28.5 trillion limit. And that's what that article was. Nancy Pelosi adjourned the House of Representatives for 7 full weeks. Starting last week, so there will be no action on it for at least 8 weeks. But sometime before September 30th, they'll get around to that. We also know, going to the markets here, Warren Buffett, Berkshire Hathaway, came up with something that they call the Berkshire ratio, or they call it by different things, but a long time ago, when it used to matter more than it does today. He started measuring how relative valuation in the market. He would take all the entire market capitalization of the top 500 stocks in the S&P 500, and he would divide them by GDP on the rationale that the largest companies in the United States should produce the majority of the goods and services in the United States. And, there are large private companies. So historically, that number ran about 80%. Again, they told us in this last GDP report that expected GDP for 2021 is going to be $22.7 trillion. So if we go and look up what's the value of the 500 stocks, 505 actually, in the S&P 500, that number is about $32 trillion. If we take 32 and divide it by 22.7, we get 140%. Which is the current market valuation based on that metric, compared to an historical average of about 80%. And what is or isn't mentioned, like I said, it depends on what you read. If you have a mind for it, like I say, I read the actual reports. Their current dollar personal income decreased 22% or $1.32 trillion. Hello. Anyway, sorry, I don't think anybody's listening to me, but certainly not the people that matter. Anyway, let's go to the markets. July 30th, which was last Friday, is when our week ended, and we calculate week to week. For the week, the market was down 16.53 points, which was 0.37%. So on our portfolios, we would have expected to lose $375, right? We have 4 portfolios. One is the 2 of them are the top 30 stocks in the S&P, and the top 30 stocks represent more than 50% of the value of the S&P. So if the value of the stock market is 140% of GDP, and our 30 stocks represent more than 50%, that means our 30 stocks represent more than 70% of GDP, right? So we made 2 portfolios out of those 30 stocks, And one, we market capitalization weighted. In other words, the larger the company was, the higher the investment. And then the other one, we equal weighted. When you do that, you don't get any companies at all in industrials, materials, real estate, or utilities, and only one energy company. So to correct for that skew, we created a third portfolio, which takes all 11 sectors in the S&P, takes the top 3 stocks in every sector, call that one the top 3 by sector. And then I have a discretionary portfolio called the Large Liquid Leaders. Based on market action last week, we would have expected to lose $375. Top 30 cap weight lost $1,530, which is a little more than 4 times what it was expected to use. Top 30 equal weight lost $711, which is a little less than double what it was expected. Top 3 every sector lost $262, which is not as bad as expectations. And my discretionary portfolio before hedges gained $411 for the week. If we look at the particular stocks, remember, we took the top 30 stocks, and the differential in between the largest stocks and even the 10th stock down is enormous. Your largest stocks in order of capitalization are Apple, Microsoft, Amazon, Google, Facebook, JP Morgan, Berkshire Hathaway, Johnson & Johnson, and Procter & Gamble. Okay, those are the behemoths. But going back to the top 30 cap weight, looking at the stocks, we had 2 that went up. Tesla went up added $263 to the portfolio, which is a gain of 6.8%. It's a story stock, so Elon Musk must have been performing well. Don't know. Also, they had earnings, so he must have had good earnings. Google added $137 to the portfolio on earnings. Google did well in earnings measure. So those 2 stocks added $400. We had 5 stocks that lost the portfolio money. Remember, this is the one that went down $1,500. And Microsoft lost $214. Facebook lost $229. PayPal lost $231. Apple lost $262. And Amazon lost $987 for the portfolio. If we look at that list, Microsoft stock should have gone up by news-related and other concerns, but it didn't. So just trading anomaly there, profit-taking, whatever. Facebook was pure profit-taking. As you'll recall from last week, the stock went up 9%, over 6.4% in a particular day last week. So this week, some investors took profits. That stock fell 3.6%. PayPal, earnings difficulty, soft outlook. Remember that $1.32 trillion that came out of the lowest end of the economy. Yeah, well, PayPal, they used to buy things on eBay and or sell things on eBay and pay. So PayPal had disappointing forward guidance, but their stock fell 10.7% last week. Huge. Apple stock was down. Record earnings, tremendous earnings, but I'm not going to call it soft forward guidance, but less than this quarter, and the mindset on Wall Street is, even if your earnings broke all-time records, the fact that you would dare let your sales fall, 2 or 3%, for the coming quarter is just anathema. And their stock fell 1.8%, which is not huge, but again, by capitalization weight, they took a lot out of the portfolio. And Amazon lost almost $1,000. Inline earnings, I would characterize them. Jeff Bezos and crew, stellar performance always on the conference call. That even if they're looking at a bad forward quarter, they'll never tell you. Good promoters. But what did it for them is, if you look at the composition of their earnings, not their revenue, their earnings, their distribution business and their delivery business and their warehousing business, just like all other distribution, warehousing, and delivery businesses, have very low margin. They don't make any profit. 75% of Amazon's profit comes from a single contract with the National Security Administration and the Department of Homeland Security, where they pass information on what you buy, when you buy it, what you look at, and what Alexa hears you say. to the National Security Administration. They put in a bid. Microsoft was conditionally awarded a contract to increase this level of spying on Americans at government expense. And Amazon sued, saying that the government did not follow its own procedures when awarding the contract to Microsoft. And they went to court, and a decision was issued last week, and the judge said no, that we're going to let Microsoft spy on you now. Was a good decision. And so Amazon lost profit that had already been priced in. The stock fell 9% exactly. And because this is a cap-weighted portfolio and they are the third largest stock, it subtracted $1,000. But anyway, just the reason I'm expounding on this, you had 5 stocks that lost. The total they lost was $1,900. You had 2 stocks that gained. The total that they gained was $400. $1,900 minus $400 is $1,500, which is the exact loss of the portfolio. All right? So if you have a bias towards the biggest stocks in the S&P 500, you don't need to be buying 30 stocks. You can stick to the top 5, 6 and get the exact same results. But anyway, on to the other portfolios where we don't capitalization weight, where we weight them just same amount of money to every company in the top 30. We only had 1 stock that was up above $100, and that was Tesla. Again, 3 stocks that dropped more than $100, and same list: Facebook, Amazon, and PayPal. The difference here was $600, and this portfolio only lost $700. So again, roughly the top 4 companies approximate the portfolio, and that's just what you get when you put a portfolio together out of the top 30 stocks, or currently. Didn't used to be that way, but it is now. Top 3 every sector. This is the one that's got 11 sectors, top 3 stocks per sector. 1 stock went up, Tesla. 3 stocks went down, Facebook, Amazon, and we have to add UPS here because it's not large enough to make it into the top 30 stocks, and it went down 9.6%. Why? Earnings were good, but their earnings, the forward guidance, that little matter of $1.32 trillion, current dollar personal income. What less than rich people have to spend? 22% drop in 3 months. That little matter caused them to reduce their forward guidance, and their stock fell 9.6%. Large liquid leaders, like I say, without the effective hedges, we made $400. I sold the Pfizer. I originally started with 24 stocks. I sold 4 of them: Lowe's, Home Depot, Broadcom, and this week and Google I sold. And this week I sold Pfizer. The reason I sold it was it is just, I was worried about their ability to promote the stock. It was holding steady at in between $39 and $40, wouldn't go above $40.50, wouldn't go below $39.25, and it had just been in that range the whole time. They reported their earnings on Wednesday of last week, I believe, or Tuesday, and there was a call on Wednesday, I know that. And what they said, and this is really curious, is the effectiveness of the vaccines seems to be wearing off in 6 months. So people are going to need booster shots after 6 months. So we'll be selling a lot of booster shots, and we're going to raise the price of the vaccine 25%. But the main message from the corporation itself in its earnings call to its investors is their vaccine loses efficacy after 6 months. And in the perverse logic of Wall Street, the booster shots with the political support behind it, even though it doesn't work apparently, is going to increase sales. So their stock soared. It went above $43.50 a share. I sold mine at $42.50, $42.51, I think. The following day, Thursday, another Pfizer executive, following up on what the CEO said in the earnings call, was out at a more private meeting, but it was still reported. And he's at this meeting, and they said, "What about this Delta variant? And he said the Delta variant's a nothing burger with fries. It's going to be over by the end of August. There's no death rate associated with it. It's spreading so quickly that natural immunity is going to build up in a matter of weeks, and you're not going to hear anything more about it by after the end of August." And their stock plummeted back to $40. So think about that. That's true. Go look at the trading pattern. I mean, 39.50 to 43.50 back to $40 in 2 days based on those two statements. So those are your financial markets. Did you read that in the news? Did you? Anyway, to the effect of my hedges, my portfolio gained $411, but the hedges subtracted. What did my hedges subtract? $188.70. So net, I only made $222. If you look at the effect of the hedges, Lynn Corporation, small corporation only in my portfolio, should have added $128 to the portfolio, but the hedges cost us $40. Pfizer, we already talked about a little bit, but it was still in the portfolio last week, should have added $123, but the hedges lost us $30. S&P Global, another small company. These are all only in my portfolio because they're not in the top 30. S&P Global, good company, should have made $112. Hedges cost us $80. Honeywell should have made us $80. Hedges cost us $75. Philip Morris should have made us $80. Hedges cost us $50. Procter & Gamble should have made us $75. Hedges cost us $30. Couple of dogs in here. Kinder Morgan, which is an oil service pipeline concern, should have made the portfolio a giant $3, but the hedges cost us $25. So that one was upside down. JP Morgan, the bank, should have made us a giant $10. Hedges cost us $30. On the other side of the ledger, hedges that should have subtracted but didn't. Verizon should have subtracted $7, but our hedges returned $28. Now remember that puts and call options are separate instruments. They trade based on premium and discount that's obliquely connected to the stock price, but more concerned with forward earnings. So we actually made more on the hedge on that one than we lost. Same thing on Visa. Should have lost us 50, gained back 55. 3M, same thing. Should have lost us 54, but we gained back 60. But then you come to the big numbers. Apple should have subtracted $90 from the portfolio, and the hedges only returned 45 because the premium didn't disappear. People are willing to pay for those because they think Apple's going to come roaring back, and they're probably correct, or they think the selling was overdone. Facebook, as we talked about, they should have lost the portfolio $180, and we lost $130 on our hedges. So that's pretty in line. If we take all of the portfolios, we have 54 stocks. Only one was up more than 3%, and that was Tesla, 6.8%. 5 were up more than 2%, but less than 3%. Nothing in between 3% and 6%. Chevron, it's the third largest energy company, not in the top 30. Lynn Corporation, small company, only I own. Pfizer, small company, only I own. S&P Global, small company, only I own. And Boeing Aircraft got a plane in the air. Hurrah. Their stock went up 2.2% last week. If you look at stocks that were up in between 1% and 2%, there were 18 stocks that were up, but up less than 1%. 8 stocks that were down, but down less than 1%, 7 stocks that were down in between 1% and 2%, and only 5 stocks down more than 2%. In order, those were Facebook on profit taking. Lowe's Corporation fell 4.06%. Objectively, it's because of current dollar personal income decreased 22%, or $1.32 trillion during the quarter, is objectively why. I think it's because the CEO doesn't know how to speak to the investment community, and these investors are hedging themselves. And another objective measure, 2 of the analysts got as mad at him as I did last quarter for talking his own stock down, and they downgraded him going into earnings to protect their reputation over his. So the combination of those two things sent their stock down 4%. Never get a CEO. Don't invest in a company where the CEO does not know how to speak to the markets. Pick a good liar like Elon Musk or Jeff Bezos or somebody. Seriously, you'll do a lot better in this market. Amazon fell 9%. UPS fell 9.58. Reasons I've already mentioned. PayPal fell 10.7 on the earnings. subscriber. Anyway, just on the earnings, 10-point and forward guidance. And that's the 5 stocks. I'm still hedged. Excuse me for a minute. Costs me money every week. Every week I have to show up here and tell you how much money I cost myself. This week it was half. We made 200, lost 220 on the hedges. Last week it was terrible. Should have made 2,500, cost myself like 2,000 on the hedges. If I was a portfolio manager, I'd be fired because if the stock market falls, they just kindly call you, dear investor, and tell you, oh, the value of your assets decreased because the stock market fell. And then they're reckless on the way up because they're competing for the highest returns. But I keep my portfolio ahead, so I cost myself money every month. I listen to these people who decide to speak, the large fund managers, the strategists, and so on. Every time they decide to speak or put an article in the press, you have to assume that it's self-serving. They always do what's called talking their book, which means what they're telling you. I think that, and a lot of them came on last week and said, we're approaching, quote unquote, fiscal cliffs. This seems to be the narrative amongst the extraordinarily wealthy. The Fed stimulus has to come down sometime in 2022, fiscal cliff. The real estate market, by my calculations, I seriously heard a guy say this, by my calculations, sometime in between the first and second quarter of 2022 next year, it's going to come down. Fiscal cliff. We're not going to, the Federal Reserve activity. And they're talking about all these fiscal cliffs. And in the GDP report, current dollar personal income decreased by 22%. Or $1.32 trillion. I agree. I disagree with them in principle. I think they're talking their book. What they're telling you to do now, they did last month. If you follow them in doing it, it drives the prices of their assets up. They sell, they move on to the next thing. Anytime you see one of these people in the press or on TV, you have to assume they're talking their book. They're very opportunistic. They're very self-centered. To them, a $1.32 trillion in current dollar personal income is pocket money that they give the maid. They haven't been in a grocery store in 25 years. All right. So anytime you see them, please remember that, they're talking their book and it's still informative. At least it tells you what their book was. So they're worth listening to. But I agree with them in principle on the idea of fiscal cliffs. I personally think the fiscal cliffs that we have to worry about and are not are the rent, the eviction and foreclosure moratoriums that came off as of July 30th. Plus the other ones that they mentioned, the unaffordable cost of shelter and healthcare and food. Also from the GDP report, I did not mention this, I'm sorry, consumer inflation. There's a more authoritative report that comes out on consumer inflation called the Consumer Price Index. It comes out next week. I'll tell you what it says. But from the GDP report, consumer inflation during the second quarter of 2021 was 5.7%. The consumer inflation for the first quarter of 2021, according to the same report, was 3.9%. If you average those two numbers out and project them forward, the consumer price inflation for 2021 is projected to be in between 19 and 20%. That's a fifth. What you used to buy for $1 now costs you $1.20. Think about that. And plus current dollar personal income decreased 22% or $1.32 trillion. Anyway, so the fiscal cliffs that I worry about are what's happening at the bottom end. Our politicians and all these people, I'll reiterate it, I've said it before, in my opinion, they do not see it coming. They are so isolated and so inured from reality. They don't see it coming. They're not going to know what to do about it. You know, people are warning Pelosi about, these things. What'd she do? She adjourns the House for 7 weeks. She did that on purpose. She's been doing this for years. What she's just set up is when they come back, it will be in the middle of a crisis. You'll have 2, maybe 3 million Americans evicted from their homes, or foreclosed upon. You'll have demand collapse or significant diminution in your retail stocks and so on. And she set it up so that they can come back into the midst of another crisis, in my opinion. Debt ceiling, not taken care of. Didn't address any of it, just, disbanded the House. And this is why the episode is named Dearest Marie. This is not new. It virtually happens every time the rulers become too insulated from the populations. In the case of the Sun King not the Sun King, his son, but just prior to the French Revolution, they were borrowing tons of money. And in those days, their finance minister, a guy by the name of Jacques Necker, came up with a novel way to borrow money. The only people that had it at the time were the Belgians and the Dutch and the Laplanders. And they promised them grain. World was cooler then. And France grew much better grain and vegetables and so on. So they used to sell what we would call futures contracts to grain and vegetables. And the regime was borrowing constantly. And the king and the court were used to this borrowing and spent appropriately on wars, mind you, funding that American Revolution, for example. But anyway, it got to the point when they set up the system like that, it worked good for probably 10 years. But once you have something running for 10 years, all the bureaucrats involved will absolutely do anything so that they don't miss their grain shipment to Belgium or to what's now Sweden, because they're loaning us the money. The king cares about that. And the population didn't have enough bread. And they came in to a meeting of the court. And this is shortly before they stormed the Bastille. And they informed the king that the peasants, had nothing to eat and how serious the situation it was. First, the king had ever heard of it. Anyway, in the meeting was Marie Antoinette. She was the only person with the presence of mind to suggest opening the royal granaries to the peasants, at which point they were informed that the royal granaries were also depleted. And then the revolution. Too bloody. Anyway, I'm worried. Thank you for joining me. See you next Tuesday. Do Bigenio. That means goodbye.
I'm Dave Dahl, creator of Dave's Killer Bread, a well-known, against-the-odds success story. To give back, we built a podcast studio called TalkCast PDX, a state-of-the-art facility to produce your own podcast. TalkCast PDX is a place where every opinion is accepted. If you've ever thought about it, do it. Use your voice and make a difference at TalkCast PDX.